how to find investors. Hey, what's up guys? Hope you're all well. So apologies, I had a little bit of a break. I had a week off, so I didn't upload a video last week. But that's okay because I am going to hit back with one of my best videos ever. And that is one of my hidden secrets on how to find investors. But before you even consider working with an investor, you should take note of my big warnings, which I'm going to save right till the end of the video. So let's go ahead and get started. So if I rewind to 2014, where I had probably half a dozen properties and I'd run out of money, but I knew what I needed to do in a certain market and location, I couldn't comprehend why I could not keep buying properties and why there were so many people around the rest of the country and the world continuing to ramp up what they were doing. It was my own mindset and my own self-belief or lack of self-belief as to why I couldn't continue to keep buying properties. And it was the golden goose of working with investors. Now, if you are either starting in property or you are already at the very early stages and you're using your own money to invest in properties for buy-to-lets or flips, you will eventually either run out of money or you are in a position where you cannot get started because you do not have any money. And the key to unlocking both of those directions is working with investors. Now, going back, working with investors, I thought was definitely for something only professional people working in high-rise buildings in the financial markets of Canary Wharf and Wall Street in America and all these different things did. It wasn't for little old country bumpkin me from Norwich who was just buying a few properties and turning them into student accommodation. And because of that negative mindset and because of that disbelief in myself that it wasn't for me, it wasn't the right location, I wasn't the right fit, and I wasn't playing in the right markets, investors would not want to work with me. But how wrong was I? I went on to buy over 150 separate deals, most of those with investors until 2019. And then I started using my own funds because there is lots of positives to work with investors. And the biggest positives is to get going and get started. But there are some negatives, and this is going to be part of my warning right at the end of this video. But before we get into the negatives, let's talk about the positives and how you can find investors. Now, before you even start to do that, you need to really make sure you are in the right mindset. And there are really easy ways in order to change that mindset. And that is by watching YouTube videos and reading lots of books and listening to podcasts. The problem is that there's so much out there as opposed to 10, 15 years ago where there was literally nothing apart from some good books. So you do have to be a little bit careful on who you're watching and who you're listening to and how much experience they have behind that screen. So you can really try to understand and get behind scratching the surface and seeing what they're saying does work for you and does actually work in today's market. And unfortunately, there is no easy option and there is no quick answer to that. You're going to have to kiss some frogs and you're going to have to waste a bit of time until you find the right person and the right podcast and the right book for you. Now, I can try and help you a little bit. Rich Dad, Poor Dad is a great way to change mindset and dabble in this using other people's money world. I really like the guys at Progressive, Rob Moore and Mark Homer. I think their early books are really, really credible and worth the read. And they've definitely got some DVDs and some YouTube videos that you can watch, which will give you some of that good insight. And of course, very biasedly, my own YouTube channel. I am a proven person who still invests in today's market, who only is where he is today because I took the leap and decided to start working with investors and started to try and find them out. So how did I find those very first investors when I didn't have a huge amount of experience? Well, I guess I was a little bit ahead of the game because I did have, albeit very limited, some experience. And it was experience in the market that I wanted to work with investors. And I have to be brutally honest, this catapulted me, I think, months, if not years ahead of the game because I was able to demonstrate projects, successful projects in the market, and I just wanted to add to those with new properties. So an investor coming to me or me talking to an investor had something already that they could feel, touch, and visit as a demonstration of what I could actually deliver. But let's assume that you do not have anything that you can show an investor or you are never been involved in property. The first thing you need to do is work out where your value is. What can you offer? And if you can't think of anything, then go out there and try and make something work for you. What do I mean by that? If you're brand new to property and you have no experience, what do you do for a job? What is your day-to-day role? And how can you replicate that in the world of property? Are you really good at marketing? If so, why don't you try and create a marketing business where it markets for off-market properties, below market value off-market properties? If you're really good at sales, why don't you try doing a part-time estate agency job and start to get to learn how the world works in the local market that you're potentially going to look into? Or maybe you don't know what the local market is doing, and an estate agency is a great way to ascertain what market to get into, what location, what type of property, all of these different things, and you will make contacts that you will use in the future. Maybe you work for a construction company, maybe you work for an architect's office, maybe you work in accountant. All of these different things, there are going to be skills that you have in your day-to-day job that you can apply to property. So that's definitely one thing you can do. But also start to see how you can add value to an investor or a developer. Start to try and understand what they're looking for. An investor typically wants a really hassle-free, low-risk, good return. And the return tends to reflect the risk level. So I'm a big believer in if someone lends you the money and they have a first charge over the property, that commands a lower interest rate because the risk is a lot lower. And if they're not lending 100%, but they're lending 80% or 75% or whatever it is, the risk factor reduces, which should reflect in the overall deal. And then at the other end, you could be asking for a equity deal or a joint venture where the risk is much higher. And depending on how you structure the purchase, whether it's in your name, their name, a company name, an SPV, all adds to the risk factor. And you can push the interest rate right up to a profit share. And profit shares can deliver in excess of 100, 200% return in as little as 6 months. So it's all relative. So try and understand what different investors will want and be financially educated in all of the different moving parts in terms of what an investor will want. And eventually, when you start sitting down with investors, you'll have a good idea on where they fit on your new gauge of risk versus reward. And then after you have all of your tools in your belt, or you've got some things that you can grab hold to, it's then about trying to find investors. Now, I'm a big fan of networking, and I think networking is a great place to meet like-minded people, fellow property investors, and other people involved in the property world. The problem is 99 times out of 100, you go to a networking event and everyone is there looking for an investor. So you're all trying to climb over yourself for the same investor. But try other networking events that aren't property related and go there without the intention of doing business and finding investors, because what you'll do is just by going there and having fun and learning about what people do and taking an interest and maybe helping them out indirectly, you will start to get your name out there and you will build trust and you will be able to start working with people on single projects. And it's this indirect route of establishing yourself in different circles, different groups, that will start to hopefully enable people to look and pay attention to what you're doing. Now, this isn't a quick turnaround. This is a long burner. This takes a lot of time. So be prepared to put in the legwork. But don't get me wrong, you can have a lot of fun in these places and make some really good friends. There are some other places you can find investors. Facebook is one of them. Just by publicly asking questions, commenting, giving advice, you start to get noticed, you start to get your name out there. And then when you are looking to raise funds, you can start to post on there. But there are some legal requirements, and it's definitely not as simple as other people think. And there are courses and individuals who specialize and focus on the regulatory side of raising funds. So it's really worth noting what they have to say and the best way and the legal way to ask questions and potentially gain investment. Again, add into the financial tool belt when you're starting to speak to investors. Now, a lot of people say go to family and friends, because if they wouldn't lend you money, why should a member of the public or a stranger who doesn't know you do business with you? Now, I'm actually quite against this. I think if you've got a good enough offering, you know your stuff, and the project is good enough, then the commercial relationship should be strong enough to work with a new investor. There are credits and there are benefits for working with existing investors and people you know and trust. I get that. But bringing in a personal relationship, like a friend, like a family, will muddy the water. And I personally don't think that you should ever really do that. And also, you should put yourself on a little bit of a harder level. It's quite easy to go and raise money through friends and families. You can call in favors, you can use your relationship. And actually, the deal doesn't have to be as strong. And that isn't a very good start. The deal should be so strong that you have investors falling over themselves to work with you, not the other way around. And that is really it. It's as simple as that. Finding investors in places that you would not normally look, in places you do not normally circle in. And that is where you start to get your name out there. People talk about you, they introduce you to new people, and eventually you do start to get introduced to someone who will be interested in investing with you. But here comes my big warning to working with investors. And as I have said previously, it completely changed my life. Without working with investors, there is no way I would have been able to establish myself today in doing what I'm doing. But what I do today is I use my own funds. Because there is nothing like using your own funds in a project and being able to completely change your mind, completely change your spec, completely do what you want. And there is no risk to anyone else. Now, I'm not saying you can't do that with investors, but it does become a little bit more high risk when you change strategy halfway through a project. Because if it goes wrong, it's on your head, be it. And it's still on your head, be it if it's your own money, but you have no one else to answer to. And also be prepared for passive investors who are not passive. Now, the biggest issue in any joint venture is when you have someone who is the property guy who oversees the project and takes it forward, and you have someone else who wants to chip away, because the two never go very well together. And I have personally had experience with this. When you have a direction, a method, a process, a strategy, and a way of working, which is proven time and time again, people want to be a part of that. They want a piece of that and you. The problem is not everyone is the same. Not every joint venture is equal. And there are definitely some joint ventures more equal than others. And the problem is some individuals that you work with will never be able to let go. And some individuals who you work with will never be able to accept your direction and strategy, even though that's what they've signed up for. And you will find yourself as the manager and the leader of the project, sometimes giving in to their ways of working. And then when the project starts to go wrong or doesn't deliver what it's quite should, or it's overspent, even though you've gone with their strategy, it's your fault. So my advice to anyone getting into a joint venture is to have a plan and stick to it. Joint ventures shouldn't be for the plan A's, B's and C's, even though you should have them in case they have to be used. But don't go into them with a view that it's easy to change direction, and always bring it back to plan A and the agreement to who does what, because you should never muddy the water. And that way you should avoid things. But that is a big warning, because the benefit of using your own money is you get to change direction, you get to shift with the market, you get to maximize the return, and you can either sell or keep it, it depends. And all of the return goes in your pocket. So that's it from me. Hope you found the content rich. I'll catch you all on the next video.